Alright, today we're going to discuss the financing of international trade. That will be the focus of our discussion this evening. Now, why do we need financing? Why do we pronounce financing in international trade? And is it really important? That is the question that you as a banker needs to be in a position to answer. So before we continue, I should remind you that there are some important participants of the international trade. The first two important participants are the exporter and the importer. An exporter is also known as the seller. This is an individual who either produce goods and afterwards sell them, offer them for sale. Okay, but being an exporter does not necessarily mean that you have to produce goods. Sometimes you might have to buy goods from the manufacturer and sell them overseas. Still, you are exporting. So basically, the exporter exports. All right. Now, an importer, on the other hand, is simply the buyer. This is an individual who buys goods and services from overseas. Thus, the importer simply imports. Now, to import, to buy, it means you need money, so you have to pay. Likewise, to export, okay, you need money, so you have to pay as well. That means that there are some of the services that an exporter needs to pay for them. Likewise, an importer needs to pay for some of the services. So the question is, do these two individuals have money all the time? Definitely not. Okay. Sometimes they face some shortage of funds. Now, since they face some shortage of funds and they need their business to continue, not to stop, there is where now you see financing becomes important to both of them, the exporter and importer. Now, beside these two participants of the international trade, we have commercial banks, all right? We have commercial banks, but also even the government. Government needs not only to provide safe ground for the conduct of international trade, but also government can decide to subsidize, to offer subsidies in order for the international trade or for those participants in the international trade, particularly citizens of the country, to run smooth or to have a smooth conduct of this business. That's the reason we see governments try to create some conducive environment in order to attract both foreign investors as well as the domestic investors. Because at the end of the day, we know that if the country exports more, its currency will appreciate in its value, and also even it might experience an improving economic growth. Now, what about banks? Banks as well supports international trade. Banks provide a number of services to both an exporter and importer. Therefore, when we are talking about financing of international trade, basically we're going to examine services that are offered either by commercial banks or by the government in order to assist both an exporter and an importer to smooth run the international trade. Now, let's start by defining the word business cycle or trade cycle. In economics, This term refers to the wave-like fluctuations in the aggregate economic activities, particularly in employment, output, and income. In other words, the trade cycles are ups and downs in any economic activity, right? The ups and downs on or in any economic activity. By saying ups and downs, it's sort of like oscillation. Let's say this is 0, here you have positive number, and down here negative number. So when you say the trade cycles, it means there is a time you might be doing fine, but there's a time you might doing not fine. Okay, so it oscillates like this. All right, so the reason we say it's a wave, it's a wavelength, all right, or wave-like fluctuations. All right, so to complete a cycle, it means, for instance, from this point here to this point here, this is one cycle. Okay, so within, let's assume now this cycle is a fiscal year. Okay, now if it's a fiscal year, we assume that within a year you might be doing fine, but also it's very possible that you might not be doing very well. Now if you are not doing very well, do you really need to close the business? No, but financing can assist you to proceed or to move on. One author defined trade cycle as a fluctuation in aggregate economic activity. But according to another one, they said the business cycle in the general sense may be defined as an alternation of periods of prosperity and depression. This is what I like most. It is the definition that I prefer. The alternation of the periods of prosperity and depression of good and bad trade. Okay, again, consider this diagram here or this illustration here. You see that, as I mentioned before, suppose that this one is 0 and here you have 1, 2, like these are positive numbers, and down here you have some negative numbers. Let's say 1 and 2. Now in a fiscal year you might have a period of prosperity. Now the period of prosperity is when your business is doing fine, is on this positive side. And then there is the period of depression, right, or slump. This is when now you are on this other side. All right, so financing is mostly required to assist your business to pass through the period of depression. All right, this is the rationale or the significance of financing. The trade cycle is the recurring and fluctuation level of economic activity that an economy experiences over a long period of time. The 5 stages of the business cycles are the growth, the peak, recession or contraction, slump, and recovery. So, in a business, once established, might grow, okay, and after growing, it will reach to a certain peak, right, the summit. But now, you really need to be highly innovative, highly aggressive in marketing and selling in order to stay at the peak. Otherwise, the recession might kick in, and before you know, or if you're not careful enough, you might plunge. Okay, slump is a very serious fall in price. Now, let's turn our attention to the definition of trade finance. Due to unpredictability of the trade cycle, most businesses depend on external financing to meet their operating fund requirements. And this is what we call trade finance. So trade finance is more than the normal lending. Trade finance basically means an innovative financial products and services that assists both importer and exporter to fulfill their financing needs. All right, so you see, trade financing are innovative financial products Now, when we say innovative financial products, this can explain as to why not these facilities are available to all banks, or not all banks have exactly the same trade financing facilities. Every bank have their own facilities that they offer to their clients in order to facilitate the trade finance or the international trade. So trade finance is a source of working capital for many traders in need of financing to procure, process, or manufacture products before they sell them to the market. Trade finance is therefore an important for any country as it facilitates international trade. As international trade increases, so is the importance of trade financing. In absence of an adequate trade finance infrastructure, in effect equivalent to a trade barrier. In absence of an adequate trade finance infrastructure is in effect equivalent to a trade barrier. Why we say in absence of inadequate trade finance is equivalent to a trade barrier? Consider this simple example. All right. You have an exporter here. You have an exporter here who have secured a deal, okay, who have secured a deal to ship 20 containers, okay, 20 containers of cashew nuts to, let's say, India. Now, this exporter does not have higher capital. Let's say his capital is around $100,000 USD. However, the total value of the export is more than the 100, let's say is about 90,000 USD. Please mute your microphone. Now, this exporter will be required to procure the cashew nuts, all right? Secondly, will be required to process the cashew nuts. Third, will be required to obtain export license. Fourth, will be required to pay shipping fees. Now, suppose that he will be repaid 90 days. Suppose that he will get paid 90 days after the date of shipment. What does this mean? It means that if this exporter will have to use, let's say, 98,000 USD, is going to remain with only 2,000. With 2,000 USD, he can no longer continue to operate. He will have to wait for the 90 days to lapse so that he can get paid in order to continue with the business. But now, during that, with the waiting time, most likely he will lose a lot of opportunities due to shortage of finance. And that is the reason now, you see, we need him. We need for him to secure a financing. And he can secure financing for his business either from the bank or from the government, depending with the arrangement in place. In absence of the finance, you can see now this is some sort of trade barrier. Why? Because he cannot continue with the business until he gets paid. Remember, competition is stiff out there. And not all the time importers are willing to pay in advance. Importers will prefer an open account, which is highly discouraged by exporters. But now, if you as an exporter, you're not willing to sell under this term, open account, maybe someone else is willing to do so. And that means your position will be highly jeopardized due to stiff competition in the international market. Importers facing difficulties in assessing trade finance have limited chance to offer competitive terms to their suppliers, the like of advance payment terms or documentary collection. Also, exporters with limited supply of trade finance will have difficulty in penetrating the market. Because while importer may prefer to buy on open account or on deferred terms, the supplier may not be in the position to accept or to offer such terms. You see, so with the presence of financing, it is possible now for an exporter to offer an open account terms and for an importer to offer or to enter into an advance payment term. Okay. Why or how is it possible? If an exporter insists to be paid in advance and for some reasons the importer have shortage funds, he can simply acquire financing from commercial banks, right? Conversely, if an exporter is reluctant to accept open account, the presence of commercial banks can encourage him to comply or to agree to these terms. Why? From the commercial banks, he can get a guarantee, like payment guarantee, right? But also he can get other kind of financing if the problem is liquidity crisis. So let's see pre and post shipment financing. Starting with the pre-shipment finance. This is issued by a financial institution, let's say a commercial bank, when the seller wants the payment of goods before shipment. Remember, the seller is an exporter. So, if the exporter demands to be paid in advance, okay, payment for the goods before shipment is simply advance payment or payment in advance. Okay. This kind of facility is common known as packing credit. This is how it is being referred by some other commercial banks. The main objective behind the pre-shipment financing or the pre-export finance is to enable the exporter to achieve the following. Number one, to procure raw materials. Number two, to carry out manufacturing process. 3, to provide a secure warehouse for goods and raw materials. 4, to process and pack the goods, and also to pay for shipment or to ship goods to the buyer. Take an example of a simple exporter, okay, a simple exporter who have received a deal to ship cashew nuts overseas, let's say to India. Depending with the capital, the amount of funds in hands, is supposed to have budget to procure cashew nuts. Again, after collecting the cashew nuts, what else? He needs to transfer them, to carry them to a certain warehouse or to a processing facility, let's say a plant. All right. Over there, he will process or continue with the manufacturing process, wherever. Again, the produced cashew nuts needs to be safely stored in a certain warehouse while waiting to be shipped to India. And remember, before shipping, he needs to obtain the export license. And finally, pay for shipment and ship the goods to the importer. So if the importer refuses to enter into the advance payment contract, it means this exporter will require financing from commercial banks or another financial institution. Now, if they are to come, or if he is to come to your bank, the facility that you have to offer to him is referred as the packing credit or pre-shipment financing. Now, beside the pre-shipment financing, we have post-shipment financing. Post-shipment financing is a kind of loan provided by a financial institution to an exporter or a seller against a shipment that has already been made. Okay? Consider in our first example, that is, we have an exporter who has a capital of, let's say, 100,000 USD, and he entered into a deal that has exhausted this capital for, let's say, a total of 98,000 has been used to procure, to process, to obtain some licenses, compile documents and everything, to pay for shipment, and to export the questionnaires to, let's say, India. All right. So basically, with only 2,000 USD, it's impossible to continue with the business. Now, when he is waiting to be paid, what will he be holding? Once you sell on credit, you're going to end up with some invoices. If not invoices, can be a bill of exchange or a promissory note. Right? Therefore, using these facilities, the bank can offer to such an exporter a pre-shipment finance, a financing facility that is offered against a shipment that has been done. Having made the shipment, the exporter might be in need of funds to meet other operating requirements or even making another shipment. This type of export finance is granted from the date of shipment of the goods to the realization date of exporter's proceed. Therefore, if today, which is 3rd of March, so if the 3rd of March is the date of shipment, and this individual exporter will be repaid 90 days after the date of shipment, then the bank can issue or can grant the post-shipment financing, which will run until this individual is paid. Now, what is the role of commercial banks in international trade? Besides those facilities that we have discussed, commercial banks provide different credit facilities. The credit facilities are such as loans, where we might have personal loans as well as business loans, and both can be short-term, medium-term, or long-term. Now, besides the loans, commercial banks offers overdraft facility as well as the parking credit that we have already discussed. But also, from commercial banks, we can get guarantees of different kinds. Remember, we have financial guarantees are of two types. Guarantees are of two types. We have financial and non-financial guarantees, right? Financial guarantee is when money or payment is involved, A non-financial guarantee does not involve money. So an example of financial guarantee is the advance payment guarantee. The advance payment guarantee allows the beneficiary to access advance payments to facilitate procurement of production of goods for delivery to the intended party. Let me give you a practical example here. Let's assume that Miss Lee is a Chinese exporter. This is a Chinese exporter. She has secured a very attractive deal to export some lush products to some countries in Africa. Let's say to South Africa, to Tanzania, and Kenya. Okay. Now, it's massive of products, large products that are supposed to be shipped to this market. Now, Ms. Lee has managed to procure raw material. She has managed to process and manufacture. She has managed to obtain export license, but now she has a shortage of funds to pay for shipment, that is the shipping fee, and insurance. Now, if she cannot fulfill these two parts of the deal, automatically she has lost. Why? Because the importer is willing to pay the moment they have received all documents. Okay, and let's say now this is under the letter of credit or open account. So Ms. Lee does not really need to give up. What she can do is that from a bank, she can obtain advance payment guarantee and send it to the importer. The advance payment guarantee serves as a guarantee that once the importer pays in advance a certain fraction or percentage of money, let's say the total deal is worth USD 95,000 and Ms. Lee only requires 15,000. All right. So with the advance payment guarantee, the issuing bank is guaranteeing the importer that if the importer pays Ms. Lee 15,000 USD in advance for her to fulfill her contractual obligation, if for any reason Ms. Lee won't fulfill the entire contract, the bank will reimburse the importer following the loss that the importer will have suffered. And now this guarantee, remember, is for only 15,000. Now you see, without bank providing this guarantee, most likely Ms. Lee will stuck. She has managed to procure raw materials, process, obtain export license, but now she's stuck on only shipping fees and insurance. The presence of banks or the presence of these facilities have assisted her to complete the deal. Commercial banks also offers custom bonds. Custom bonds allow a buyer or a seller to postpone payment of tax until goods are sold. I'm sure we are all aware that when you import, right, when you import at the port, you're supposed to meet all custom fees, right? And there are a lot of custom fees: the tax, tariff, wharfage, railway levies, etc. There are a lot of fees. Now, if for some reasons the buyer or the seller does not have funds to pay or to meet these fees, a bank can offer a custom bond. So with a custom bond, the buyer or the seller, the exporter or the importer, will be allowed to continue with the trade and in a later day come to pay for the appropriate custom fees. From the commercial bank, we can as well get the letter of credit. Remember, a letter of credit offers a secure terms of payment, a guarantee to an exporter that he will be paid provided that he fulfill all terms of the letter of credit. You see? On the other hand, the letter of credit allows suppliers to access credit against presentation of documents at the counter of the negotiating bank without waiting for goods to reach the buyer. Take an example of a Chinese exporter who ship goods to Tanzania, let's say. We all understand that it might take up to 45 days or 40 days before the ship can arrive to the Dar es Salaam port in Tanzania. Now, if the agreement was under the letter of credit, it means this exporter is supposed to present all documents. Okay, we call it complying presentation. Okay, so it is following the complying presentation, the Chinese exporter will be paid. For the bank to make payments does not necessarily have to wait for the 40 days to lapse unless there is any other agreement. Otherwise, the moment the Chinese exporter have presented all required documents such as the commercial invoice, the export license, insurance documents, the bill of lading. Okay, if all these documents are submitted or are presented by the Chinese exporter to the bank ought to pay her. So you see, this exporter is going to get money even before goods arrive to the importer. So, with the presence of commercial banks, the letter of credit, sometimes even the documentary collection, can allow the buyer to obtain credit terms from the seller under the acceptance of payment of the bill of exchange or acceptance of the credit terms under the agreement that payments will be done in the future. Recall the documentary collection. Okay, under the documentary collection, an exporter encloses the bill of exchange. All right. Now, a bill of exchange, specifically the TINA bill of exchange, is payable after lapsing of some few days. Let's say 30 days, 40 days, 60 days, etc. You see. So now you see, with the presence of commercial bank, still the buyer can access the goods. All they have to do is to simply accept the bill of exchange. On maturity, they'll come back to make payments. And since the bank is involved in guaranteeing these facilities, then the seller has no any problem. Likewise, with a letter of credit. With a letter of credit, It's not only that once the presentation of documents have been done, payment will ultimately be done. Sometimes there can be an agreement for payments to be done after lapsing of some few days. It can be 60 days, 40 days, etc. Anything is possible, you see. So the bank will accept the documents, but payments will be done in the future. Now, on the other hand, the buyer will be allowed to collect goods and continue with the trading activities. And then on maturity will come to effect payments. So this is the better of having commercial banks. Now, suppose that during the waiting time, okay, during the waiting time, let's say it is the documentary collection. Now, documentary collection is accompanied with a bill of exchange. Now, let's assume that this bill of exchange will be paid after 45 days. But for some reasons, the exporter is not willing to wait for 45 days. What will happen? The exporter can simply take this bill of exchange to a commercial bank and discount. Once the bill is discounted, the exporter will get money instantly, and then the bank is the one that will have to wait for the 45 days before it could get paid. All right, but please remember, discounting of bill of exchange or commercial invoice is done with recourse. Lady Crow's letter of credit, unlike other categories or types of the letter of credit, this one authorize advance payment. Okay, so with the Red Cloud letter of credit, a certain percentage of total payments will be paid in advance to an exporter so that the exporter can meet some business costs, for instance, shipping fees or processing costs. And once or the moment he submits all the documents to the bank, then the rest of the money will be paid. Now, in international trade financing, also we have these specialized houses. Okay, now specialized houses and credit agencies, they as well offer some financing to both exporter and importer. Now, one of the financing being done by them is leasing. Leasing is more useful for long-term financing needs. It is for acquisition of equipment or machinery requiring large sum of cash outlay. Under leasing, equipment or machinery can be acquired without having to make a large one-time cash outlay. Usually, a leasing company will purchase and lease to a company in need against a monthly rental fee. Suppose that we have an exporter. Now, this is the exporter of service, all right? You know, not all the time you'll be exporting goods, physical goods. You can as well export service. Service, for instance, construction activity. Now, let's say we have an exporter who have come in our country to construct standard gauge railway, okay, SGR. Now, that exporter comes from Turkey, and to construct a railway that long in the country, he needs a lot of equipment, starting from the motor vehicles, okay, motor vehicles of all kinds, cranes, etc. Now, this exporter does not necessarily have to ship these equipments from his country to Tanzania. No. Since in Tanzania there are some motor vehicles, in Tanzania there are different cranes, okay, the exporter can easily go to specialized houses and lease these equipments. By leasing these equipments, all have to do is to enter into an appropriate contract which will require him to be paying these lease rentals or rental fees as per the contract. Now, there are two types of leasing. Of course, currently there are different types of leasing, but the most commonly are these two. First, an operating lease, and second, a capital lease. With an operating lease, this is an agreement to use and operate an asset without the transfer of ownership. Okay. A very good example is this Turkish exporter who construct SGR in the country. Okay. For him, operating lease is the most suitable. Why? Because through the operating lease, he can rent some buses to move around those employees or workers, laborers, but he can as well rent some heavy machines like the drilling machines, JCB, caterpillars, okay, motor vehicles such as bowsers, right? So that at the end of the leasing contract, and particularly when the project is completed, he will simply go back to his country the very same way he came to our country. He does not have to sell these equipments. Why? Because under operating lease, there is no transfer of ownership at the end of the leasing contract. But another type of lease contract is called a capital lease or financing lease. Now, with this one, unlike the operating lease and the capital lease, at the end of the leasing contract, the equipment becomes, the equipment will be owned by the company. Okay, so there will be a transfer of title from the lessor to the lessee. That is to say, if you have leased, let's say, a JCB, all right, the moment the contract is finished, the JCB becomes yours. So any equipment which is leased under capital lease agreement or finance lease agreement, at the end of the contract, the ownership will be transferred from the owner of the equipment, that is, let's say, the financing firm, to the client we've just entered into that contract. Also, this financing firm offers forfeiting. Specialized house or other trading institution may, under forfeiting arrangement, purchase from exporters receivables without recourse. Okay, we discussed this. Okay, may purchase the receivables without recourse and discounted rate to allow exporter access financing before maturity of the bill. Think of the following. You have this Chinese exporter who have shipped different goods to different importers. Okay, let's say some importers are in Tanzania, some in South Africa, some in Kenya, and some in Rwanda. And all these have promised to pay after lapsing of some few days, let's say ranging from 40 to 90 days. Okay, this is when payment will be realized to the Chinese exporter. So in this time, what will the Chinese exporter be holding? the Chinese exporter will be holding invoices, the bill of exchange, promissory notes, etc. These are the documents that the Chinese exporter will be holding whilst waiting to be paid. Now, instead of waiting for this period to end before he can get paid, he has two options. Option number one is to go to a bank. Okay, if you go to a bank, the bank can discount. Okay, the bank can discount the invoice, the bill of exchange, or the promissory note, and provide money to the Chinese exporter. Then it is the bank that will have to wait for these days to lapse before it will get to be paid. However, now, the discounting that is done at the bank is done with recourse. With recourse mean that if these importers do not pay, for some reasons, if they default on maturity, the bank won't go after these importers. The bank will claim its fund from the Chinese exporter. I'll say again, under the discounting service that is offered by commercial bank, this one is done with recourse, meaning that if the importer defaults, the bank will claim its fund from the Chinese exporter. Alternatively, the Chinese exporter can decide to approach the specialized houses or a financing firm where it can forfeit. Now, under the forfeit agreement here, the firm will purchase the invoice, bill of exchange, or the promissory note. But this one will be done without recourse. Now, if this one is done without recourse, what does it mean? It means that in case the importers do not pay, in case importers default, the financing firm or the forfeiter won't go to claim payments from the Chinese exporter. He will have to enforce repayment from these importers. So you can see that forfeiting and also even factoring, let me add here, even factoring, which is done by factor. Also, factoring is done without recourse. Therefore, you can see that both forfeiting and factoring are more risky. These are riskier than the discounting that is done by commercial banks. That being the reason of the case, here the discounting rate will be a little bit high. For instance, he might discount at 20%, while at the commercial bank, the discount can be at 10 to 15%, because here there is less risky, but here the financing firm is entering or is incurring a huge amount of risk. Tremendous risk is taken. And again, with the forfeiting or factoring, the responsibility or administration of debt will be shifted from the Chinese exporter to the factor or to the financing firm. Like the financing firm is the one that will have to be making some calls, to be making some follow-up to these importers to enforce repayment. While with the discounting that is done by the commercial banks, the responsibility of making follow-up to these importers will still be imposed to the Chinese exporter. So that is the difference. Now, I highlighted about the factor. Factor does factoring. Factoring is the assignment by a supplier of receivables arising from contract of sale of goods made between the supplier and its customers. A debtor to a factor. So technically, what's happening here is that the exporter have just made some credit sales, all right? Credit sales. Therefore, the exporter have some invoices, all right, from debtors. Debtors is what we call the receivables, okay? Debtors, receivables. Therefore, instead of waiting for some days before they could get he could get paid, he can simply sell all these debts to a factor. So factor will discount this at an appropriate discount rate, and then the factor will incur responsibility of enforcing repayment of this debt. But in the meantime, the exporter will receive funds from the factor and forget everything about his debts. So he will continue with his business as if nothing happened. In case importers default, that will be the risk of the factor. A factor cannot go to claim repayments from the exporter. Now, besides commercial banks and financing firms, also the government participates in this. Government participates in financing of international trade through some government institutions, and in this case, the central bank. The central bank is a very good source of trade finance. It embarks on supporting policies. For instance, the government might decide to impose tax reduction or exception for certain kind of exports, or the government may decide to establish specialized scheme to guarantee or guarantees in order to support exporters. This is done so as to support or to encourage export of goods in the country. For instance, in our country, we have the ECGS. This is called Export Credit Guarantee Scheme. In order to give impetus to the export business, in 2003, the Tanzanian government established an export credit guarantee scheme under the management of the Bank of Tanzania BOT. The main reason for this scheme is to support development of financing infrastructure that will improve credit environment in order to support exporters with viable export business, but lacking adequate collateral to secure banking financing. You know, remember, when we go to the bank asking for the loans, bank will not grant the loan based on your business idea. There are a lot of qualifications that you have to meet before the bank would give you the loan. Now, the Tanzanian government, realizing this, established the ECGS scheme. The ECGS can assist Tanzanian exporter to acquire financing just in case they do not qualify for some terms of loans. To meet the varying needs of exporters, the scheme has evolved the 4 types of guarantees to protect financing institutions against non-payment by exporters due to insolvency or protracted default. The schemes are, number 1, the pre-shipment credit guarantee, the export production credit guarantee, post-shipment credit guarantee, and the export performance guarantee. So these are the 4 schemes. Okay, these are the 4 schemes under the ECGS, and each one is meant to designated group of Tanzanian exporter. Let's see. The pre-shipment credit guarantee is a guarantee issued to a financing institution in consideration of the financing institution advancing pre-shipment credit facility to an exporter for purchasing, manufacturing, processing, and packing of goods meant for export against a letter of credit or a confirmed order. Please recall the pre-shipment financing. Please recall the pre-shipment financing. We saw that pre-shipment financing is offered to an exporter, right? That's what we saw. And why is this facility there? This facility intends the exporter to procure raw materials or to procure the required goods, to process, to manufacture if required, to obtain licenses, and finally to ship. But we discussed that sometimes this exporter will have shortage of funds because all these processes are costful. Now, in case of shortage of funds, the exporter can run to a commercial bank. Okay, can run to a commercial bank. Now, a commercial bank, if satisfied, will grant the pre-shipment financing to this exporter. So here's the question: what if this exporter, for some reasons, default? What will happen to the commercial bank that has issued this financing? Now, behind this commercial bank, there is the ECGS, which is run by the Bank of Tanzania. Okay, so if your bank offers pre-shipment financing, then this financing facility is guaranteed by the government of Tanzania through Bank of Tanzania. This is the central bank. But remember, it has to be the exporting against a letter of credit or confirmed order. That means there should be an evidence that indeed this exporter has a deal or an order somewhere, and he will be paid once he fulfills the terms or all conditions of the business contract. The export production credit guarantee is a guarantee issued to a financing institution. Now this is your bank, all right? It's a guarantee issued to a commercial bank in consideration of that commercial bank advancing export production credit facility at a pre-shipment stage to a supplier, producer, or manufacturer of goods against firm contract or agreement of sale with an exporter. All right. Therefore, if your client has struck a deal, call it done deal, and for some reasons he has a shortage of funds, they approach your bank for financing facility at a pre-shipment stage, and you finance them. Then behind you, the central bank guarantees. That is, in case of default, then the central bank will reimburse you some percentage. I'm going to show you the percentage later. Another one is post-shipment credit guarantee. This is a guarantee issued to a financing institution in consideration of the financing institution advancing post-shipment credit facility to an exporter. It's meant or it intended to enable the exporter to receive advances against expected export proceeds for continuity of export transaction and a replenishment of working capital. Please recall post-shipment financing. Post-shipment financing is offered to an exporter once he has already shipped goods. Okay. The moment he has already shipped goods, he have all the documents, except that he's going to get paid, let's say, after passing of 90 days. Now, if you do credit sales, automatically your capital is tied up with that particular credit sale. If you do not have sufficient capital, it means you will have to stop all operations, all production activities until you recover. That is, until you secure liquidity. So in this case, you're going to have to wait for 90 days before you could start a new manufacturing process. That is to say, in between, if you secure a highly attractive deal, business deal, you won't be able to take it due to shortage of funds. As a result now, bank introduce post-shipment financing. That is, bank can grant you some funds against the financing that you've already done. For instance, this one, okay, you've already sold some goods, you'll be paid after 90 days. The fact that you have some documents evidencing that indeed you'll be paid after 90 days, bank can give you financing. Now, what happens if this exporter defaults? Behind the bank, then there is the central bank. And this financing falls under the specific segment of the ECGS scheme, and that is post-shipment credit guarantee. So as a banker, if your customer approaches you for a financing that falls under the post-shipment financing, and he provides you with all the evidences that he's going to get paid, then please do not hesitate to support him, as long as you have confirmed that all the documents are intact and correct. They are not falsified. If all the documents are intact and correct, please provide your support, because the Central Bank of Tanzania or the government guarantees this kind of facility or financing. Last, we have export performance guarantee. This is a counter guarantees offered by the scheme to financing institutions to cover loss in connection with the financing institution issues of the bid bond, performance bond, advance payment bond, and guarantees in lieu of retention of money. So the export performance guarantee is there to reimburse, to support all commercial banks that will offer these credit facilities. Let me refresh your mind. What are the meaning of these credit facilities? Starting with the bid bond. Okay. Before this, first look at the word export performance. Okay. So here, most likely, or let me give you a practical example from the export of services. Export of services. For instance, construction. Now, suppose that we have a Tanzanian company, Tanzania-based company, that wants to undertake construction activities, let's say in Rwanda. And the Rwandan government wants this company to produce a bid bond in support of its application. A bid bond is a guarantee that is offered by a bank. By issuing a bid bond, technically, the bank will be informing the Rwandan government that in case this Tanzanian construction company has been selected to undertake the construction service and it refuses or fails to enter into contract for any reason, then the bank will reimburse the Rwandan government. So that is to say, the Rwandan government does not have to reinforce reimbursement from that Tanzanian construction company. That is the meaning of the bid bond. The bid bond expires the moment this Tanzanian construction company signs a contract with the Rwandan government. And what is the meaning of the performance bond? Performance bond, this one guarantees provision of quality and standard service on time. That is a performance bond. Therefore, if the Tanzanian construction company is supposed to construct, let's say, a bridge in Rwanda, and this project needs to be fulfilled within 90 days, then the Rwandan government expects that within 90 days, this company will submit a complete project, that is, a bridge that has been constructed up to the required standard, world standard, as per the contract or agreement. Therefore, in case this Tanzania construction company fails to deliver up to the expectation of the Rwandan government, the Rwandan government does not have to reinforce reimbursement from the Tanzanian construction company. Instead, the bank that has issued a performance bond is the one that will have to reimburse the Rwandan government. And what about advance payment bonds? Advance payment bond, again, is issued by a bank to its client, let's say the Tanzanian construction company, of which the Tanzanian construction company will submit this advance payment bond to the Rwandan government, requesting for the Rwandan government to give some advance payment, to give some advance payment to the Tanzanian construction company. Okay. So the Tanzanian construction company has some shortage of liquidity. It needs some money. Therefore, the Rwandan government can give this amount, let's say 10 million, okay, to the Tanzania construction company. However, the Tanzania construction company will have to take an advance payment guarantee from their bank and submit it to the Rwandan government. By doing so, it means that in case the Tanzanian construction company default from its obligation as per the contract entered with the Rwandan government, and the Rwandan government has already paid in advance the 10 million USD, then Rwandan government does not have to request reimbursement from the Tanzania Construction Company. It's the commercial bank that issued the advance payment bond that will be responsible to repay back or to reimburse the Rwandan government. And also there are some guarantees, for instance, guarantees in retention of money. Guarantees in retention of money occurs when, for example, a client wants to see a certain aspects of the contract or the machines are fulfilled, okay, before he could complete the entire payment. Let's say there is a contract which is worth 10 million USD, okay, and this is for a Tanzanian company, okay, Tanzanian company to supply some machines, let's say printing machines and drilling machines to the Rwandan government or to a Rwandan client, not necessarily the government, even a simple client, okay. Now this client promises that initially will repay only 70% of the total amount, which is 10 million. So he will pay only 70%, and 30% will be paid right after the machines have been installed and confirmed that they are running as described. So that being the reason, the Tanzanian construction company, the Tanzanian client, can ask this Rwandan client to provide a guarantee in retention of money. Call it retention money guarantee. In case of default, it is the bank that will have to reimburse the client. Now, you can see that all these services, all these credit facilities are offered by your bank. Tanzanian banks can offer these services. So having the export performance guarantee, it means that the government of Tanzania, through central bank, promises to reimburse any Tanzanian commercial bank that will offer these credit facilities to Tanzanians who want to export some goods or services abroad. That is the meaning. Now, on this table, I have the ECGS structure. You can see that the pre-shipment guarantee, the maximum cover is 80%. Duration 270 days. However, fees that a commercial bank needs to pay to the central bank is 1% of the amount. Okay, so fees here, this is the fee that commercial bank will have to pay to the central bank. Duration, this is the duration of the guarantee. Okay, and maximum cover here, it refers the percentage that is covered by the guarantee. Okay, that is to say, for instance, if the entire deal is worth 10,000, pre-shipment guarantee scheme covers the 80% of the 10,000. However, this commercial bank will have to pay 1% of the amount, and this guarantee scheme will lapse after 270 days. Export production has a maximum cover of 85%, duration 270 days, and fee is 1.5%. Post-shipment and export performance, these have a maximum cover of 75%. However, post-shipment lapse after 60 days, while export performance will lapse after 270 days. Again, the fees is 0.75% of the amount. Now, who is eligible and what are the requirements for banks or borrowers to enter into this scheme? The requirements are for financial institutions as well as the borrowers. As for the financial institution, first, it has to be licensed as a financial institution as per the Banking and Financial Institution Act of 1991. Number 2, adhering to the prudential requirements issued by the Bank of Tanzania from time to time. 3, the financial institution must apply to the scheme and upon acceptance, enter into a master guarantee agreement with the scheme. 4, the financial institution must be granting credit facilities to exporters relating to export production or pre-shipment or post-shipment or export of goods and services, priority being given to high value and value-added exports from Tanzania. Remember, the government has set this in order to promote export of goods and services from Tanzania. So it's very important to remember this before you offer that financing to your client. Again, the financial institution must request of guarantees must be related to the mentioned or the aforementioned export services. And what are the eligibility for the borrower? The borrower needs to be a registered Tanzanian natural or judicial person that is privately owned, controlled, and operated in Tanzania and is engaged in production and export of goods and services from Tanzania. So he's not supposed to be engaged in the production and export of goods or services from abroad or from other countries. No, he needs to reside in Tanzania because the government wants to promote, or the government intends to promote exports of goods and services, okay, from the country Tanzania. Again, the borrower needs to have a viable commercial projects which are the basis of the requesting of the credit. Last, the borrower needs to apply for a credit facility from a financial institution, for instance, commercial bank, relating to the export production or pre-shipment or post-shipment finance on which the financial institution has sought a guarantee cover from the scheme. So, if the applicant requests for post-shipment financing, then your bank will be supported by the Bank of Tanzania if also it has registered itself into the scheme. But recall the first requirement, eligibility for financial institution, that is a financial institution that has been licensed following Banking and Financial Act, Banking and Financial Institution Act of 1991. So that is to say, technically, all commercial banks in Tanzania are members of this scheme. Now, what are the challenges facing the scheme? Of course, these challenges are following some issues that arise in the conduct of the international trade. There are some regulatory issues, that is, it's difficult for importers and banks to comply with the regulatory requirements, for instance, foreign exchange control. Also, there are some compliance issues, for example, compliance to the terms of trade, issues such as documents to be produced. Sometimes you find that an exporter has failed to produce the required documents on time, or the required document have some inconsistencies, they need to be rectified, stuff like that. Okay. And last, the absence of reliable market information. Okay, because there is a lot of risk out there, and the market is not open in terms of information to everyone. So it can happen that some unreliable informations were conveyed to your client, and for some reasons they fail to either comply to the terms of the contract, or they get scammed. Anything is possible. Ladies and gentlemen, that marks the end of this evening presentation. Thank you for your patience.